In the last 2 weeks, the markets really had a rethink about the entire administration. After Election Day in November of last year, markets became very optimistic about a new administration, pro-business stance, a cabinet that had many business leaders, and the potential for a Trump put that would protect the downside for markets. And it's become evident that consumers and businesses have become a little more uncertain because of tariffs and the effect it's going to have on the economy. So the economy is slowing. And then measures like Doge, which have really cut a lot of federal spending, and some of these programs like US aid are potentially leading to a softening of the economy itself. And so now investors are wondering, are these Trump initiatives actually good for markets? And that's why we've had many stocks come under pressure.
Global Money Talk is delighted to have as our guest today, Tom Lee. Tom, thank you so much for being with us today.
Thanks for having me.
So, I'm not a fan of Vladimir Lenin by any means, but he said something that really struck me as I thought about what's happened recently, is that he said sometimes there are decades when nothing happens, but then there are weeks when decades happen. And you look at the first 6 weeks of, you might call it the Trump restoration, and it's been a whirlwind. So from your point of view, from the markets, what has happened that's really turned your head, and what has surprised you?
Well, I think it's a pretty accurate description what you said. Markets were very enthusiastic after the election because they saw a pro-business administration, a cabinet that had a lot of what they looked at as market-friendly folks, and what they viewed as a Trump put, which would be there would be downside protection to stock markets. And I think that carried over for most of the start of this year. It's become evident that consumers and businesses have become a little more uncertain because of tariffs and the effect it's going to have on the economy. So the economy is slowing. And then measures like Doge, which have really cut a lot of federal spending, and some of these programs like US aid are potentially leading to a softening of the economy itself. And so now investors are wondering, are these Trump initiatives actually good for markets? And that's why we've had many stocks come under pressure.
Do you think that the sort of cleansing of the Augean stables that Doge has done is putting, sort of a scare into the rest of the economy?
Yes, I mean, that's actually a good way to really characterize it. In both consumer confidence surveys, University of Michigan and Conference Board, the respondents have listed tariffs and the uncertainty around that and Doge as a bigger concern than inflation. In the regional Fed surveys, many businesses have talked about how they're uncertain if tariffs happen, if they can pass on those price increases, and it is causing them a lot of uncertainty. And then if you look at earnings transcripts for both S&P 500 or the broader Russell 3000, comments about tariffs are at 7-year highs. So there is clearly a lot of uncertainty, and uncertainty, of course, causes people to slow down their activity.
Trump has styled himself literally tariff man. He's sort of elevated President William McKinley, who was a big tariff guy in his day. What do you think the chances are for him to back off his tariffs if he sees more reactions like the ones you've been describing, that the business is concerned, consumers are concerned, and it may actually raise inflation more than he had originally thought?
Well, there is going to be a break point. Because if the economy becomes uncertain and consumers sit on their hands or confidence falls and businesses slow expansion, the economy risks going to stall speed. And nobody wants the economy to go to stall speed, because if you enter a recession, it'll force the administration to unwind everything. Because as you know, when you have a recession, you have to have fiscal expansion, meaning no austerity, spend a lot of money, and it reverses all the things that the administration is trying to accomplish. And similarly, the Fed wants to avoid stall speed, because instead of worrying about full employment and inflation, if employment starts to weaken, the Fed has to go into easy money right away. Which means a put, of course, exists at a certain level.
At a certain level, right. Do you have a sense that, for I guess us in the finance community, we think Besant is probably the smartest guy in the room. Do you think he has a good voice in this administration? If he says something, is the president likely to listen to saying, we may be approaching stall speed if you do this?
Yeah, I think he's got a lot of credibility. I think that his cabinet is not bureaucrats or career politicians, but people with private sector experience that he does respect, just like Trump has clearly demonstrated a lot of respect for Elon Musk. I don't think it's lost on Besant that markets will clearly indicate the level of stress before we start to reach stall speed. And I think that's why I don't think stock markets have to feel that there's unlimited downside if the economy starts slowing.
You said something else about Doge, what Doge has done, and concerns about employment. And it's just certainly the cuts, if they do, if the bulk of them do go through, it's not just those cuts, but it's sort of the network effects in the communities around where a lot of these federal employees are. Just as a sort of an estimate, how far do you think this could affect the unemployment rates, so to speak, as that's what I guess most of the retail investors look at? And certainly, I guess, if you're in Northern Virginia and Southern Maryland, you're a little worried about your house right now.
I mean, there are going to be distributional consequences of any policy. So I think it makes sense that if Doge wants to reduce federal waste, by necessity, it does mean lower federal employment. The question that we don't know the answer to yet is this necessarily damaging the economy? We know that in general, private sector spending gets crowded out by government spending. In other words, in an economy, government spending essentially competes with private sector. So if you're shrinking the government sector, it is reallocating money to presumably a better return on invested capital. So it should actually be better for GDP. But as you're pointing out, in regions that are affected by Doge cuts, there will be unemployment. It's not that different from globalization in the 80s and 90s, which actually left many states in the US without manufacturing jobs. And I think that Doge is sort of similar. So I don't think in that experience of the 80s and 90s, US growth actually slowed, it actually improved. I think ultimately Doge will hurt some regions, and it's going to probably be good for the economy.
So you spoke earlier about the put from the administration, the Trump put. There's another put that the market always talks about, and it's the Fed put. If something really goes wrong, then the Federal Reserve will come in and cut interest rates or add liquidity or whatever it might be, so nothing disastrous happens. That seems to be proven to be the truth. In our last conversation, I thought it was really interesting that you said that the Fed was raising rates, but they were actually dovish. It's sort of they had to do it, but they didn't really want to do it. So where do you think the Fed stands now? Are they dovish but forced to wait, or are they actually neutral and concerned about what might happen?
That's a great question. I think Fed Chair Powell himself is, on balance, slightly dovish, but he does lead by consensus. And it's apparent when you look at the Fed minutes, the discussions at these meetings, that many FOMC members are just uncertain of the consequences of tariffs and the new policies. On the surface, they realize it creates short-term inflation pressures, but the long-term consequences are unknown and possibly would slow the economy. So I think that the Fed's decision is really to be on hold until they have visibility. The market views the Fed on hold as a hawkish pause at the moment, meaning the Fed realizes the employment market isn't creating inflationary pressures, but the current inflation environment isn't necessarily convincing them that inflation is set to cool again, especially with tariffs. I think that this whole conversation will change if the labor market begins to soften. So coming back to Doge, it's possible that it's either the February or the March employment reports begin to show the negative effects of these layoffs and these terminations. And if that's the case, this will pull the Fed off the sidelines. And so the Fed has to go into full dovish mode.
In the press conferences, one question that never seems to get asked is, so the question would be, Chair Powell, unemployment is approaching 5%, but PCE is at 3% annually. What are you going to do? What do you think if we approach stall speed, I guess, and you're starting to see hints of stagflation. They're supposed to be balanced between the full employment and low inflation, and they have to choose one. What do you think they choose?
Oh, I think without question, if the labor market softens, the Fed is going to be cutting rates. And part of that is the Fed has acknowledged that last year, a lot of the inflation we're seeing is what they would call statistically lagged inflation. Things like shelter, market-based measures of shelter are showing much less inflation than the official measures, or auto insurance, which is just lagging market movement. So I would say the Fed itself acknowledges inflation, even though they may not win the PR war there, meaning markets aren't convinced inflation's cooler. Market-based measures show inflation's much softer. So I think they would end up cutting.
Makes sense, especially with a Fed chair who probably taxed, as you mentioned, slightly dovish. You mentioned sort of concerns about employment. What indicators do you think the administration or the Fed would see in the February and March employment reports that will start flashing yellow?
Well, I think they're already getting some flashing yellows. For instance, the ISM manufacturing report for February, which came out today, the employment index component was 47. So you're already below 50. A lot of the regional surveys are already showing CapEx plans are pausing, and employment could even be softening. So it's a consistent picture of uncertainty is creating economy sort of stalling. And if Friday's jobs report, which is for February, is under 100,000 jobs, I think the Fed will see that there has been a sudden change in the momentum of the labor markets, and I think that they would have to react to that. Because again, if the economy gets to stall speed and a recession starts, the Fed has to take emergency measures, which means drastic cuts rather than a cutting cycle.
In terms of the Fed, early, I think it was in January perhaps, that after particularly, maybe it was a strong employment report, that weren't pricing a cut until late in the fourth quarter. But recently, the market now the future seemed to be pricing one as early as June. So if these signals start flashing red, do you think they could move even before June?
I think that's going to be the focus. I think there's a 64% probability of a June cut, and it's 75% for July, and only 28% for May. If we get a soft February employment report and jobless claims continue to rise, then the probability of a May cut likely goes to 100%.
So March is probably too soon for them to be able to do anything.
Yes.
Could go as quick as May.
That's right, because March, you'd only have this employment report to work with.
Right, and this employment report last month was actually quite strong.
Yeah, and then you'll have February CPI, which is coming out in roughly 10 days.
Right. In your Granny ETF, and just switching gears a little bit, you look at a combination of short-term themes and sort of longer-term themes. And I'm curious, and I think our viewers would love to hear what makes Tom Lee sort of change his mind. I guess it's different things for short-term, and medium-term. But what are the things that say, my thesis has to change? I'm going to adjust one of these. Sort of what things do you look at?
Well, I think if we start from a high level, as long as the economy's in expansion, and as long as there's firepower on the sidelines, meaning investors aren't over-invested in stocks, stocks should continue to rise. And that's been really the right way to look at markets since 2009. If the business cycle matures or experiences a shock in a way that triggers a recession, and it's one that begins to look really severe, then markets can't go up anymore. In other words, we could have a growth scare this year. And I think that's this is all shaping up to be. And because we could have 1 or 2 weak job reports, Fed starts to ease faster, and it prevents the economy from stalling. But if we have a full-blown recession, that's going to be hard to be recommending stocks. That's not the case, and that's not really what we're expecting. I think the second thing that would change our view is if stocks become overvalued. And there's many ways to measure it, but to me, as long as the PE of the stock market is below the PE of the bond market, I don't think stocks are expensive. The 10-year yield is 4.3%. That's roughly 23, 24 times earnings. The median PE in the S&P is 17 times. So the stock market is still cheaper than buying a 10-year treasury.
Wow. I don't think many people think of it quite that way in terms of valuation. When was the last time that the stock market was, more expensive than the bond market? And, with the metric that you just said, roughly.
Well, we've had many times in history. So that was the case in the late 90s. So if you look at the PE, the median PE, it got close to 25 times. And the 10-year was at an implied PE of 20. So the market was expensive. That's really a pretty simple rule of thumb. And, if yields move up a lot, that's another way stocks can look expensive, but yields have actually been declining.
Right. Can you sort of give us in maybe one or two examples of in the past, when you've been in the strategy space for a long time, when something made you sort of change your mind? Was it the recession? Was it COVID?
Yes. Well, in 2022, at the start of the year, and it's our clients were really aware of it. We saw the risk of the economy slowing dramatically, and we thought the market could have a drawdown of 10% of the first half. So we had caution around the first half, but we turned bullish in the second half of 2022. Markets didn't bottom until October, so it took 3 or 4 months longer, but actually that was the correct time to turn bullish again, because every purchase of a stock from June to October 2022 became profitable within 3 months. So that's not even 3 years ago.
Continuing on that theme, it looks like the next few weeks are going to be pretty important to see, well, certainly the first half and maybe the rest of 2025 go. Any sort of forks in the road, like a decision, something that we'll see very quickly? Is it tariffs that are supposed to go through tomorrow or very soon that may or may not go through? Is it they actually pass a budget, which the House passed a version of the budget, I think, which actually surprised everybody. Where are sort of the forks in the road in the short term?
Well, there's quite a lot of important things happening this week, actually. It's not just tariffs that are going to go into effect tonight. And I think in some ways the market's priced that in because we've been expecting it. There should be no surprise it's happening. The surprise, of course, would be tonight if there is a stay of execution. Somehow there is a breakthrough in the negotiations. Tomorrow, the president makes an address to the nation. On Wednesday, Scott Bessent is speaking at the Economic Club of New York, and that's going to be very widely watched because the Trump put is something people are wondering. We've had so many conversations with investors lately wondering, if the White House is measuring their success by lowering interest rates, what does that mean for stocks? That's his chance to really talk about that. And then on Friday is the jobs report for February, and then Fed Chair Powell is speaking at 12:30, 4 hours after that jobs report comes out. So this week is a lot of important things happening that are going to be very closely followed.
I want to switch gears just a little bit, and it's something that happened very recently where you turn around and it's why is Bitcoin up so much on Saturday? And you quickly find out that the president has put something on Truth Social. And he talks about a digital reserve and what he wants to put in it. What do you think about the United States having or any other country having a digital reserve?
I would probably answer it by saying that we're constructive on digital assets. We think blockchains have really proven to be a trusted vector in an increasingly trustless world. And if digital assets become a form of an alternative payment system, and Bitcoin is viewed as digital gold by buyers of Bitcoin and people who hold and support the network, then it makes perfect sense for governments to actually treat that as a commodity that they do want to have some control over. If the U.S. owns 1 million Bitcoin, which could be, what the strategic, we really don't know the composition and how much Bitcoin they'll own, but if they own 1 million Bitcoin, they would be the largest holder of Bitcoin in the world after Satoshi, that would allow them to exert significant influence on the network. So I think it makes a lot of sense if you look at financial instruments and if Bitcoin becomes increasingly viewed as digital gold, that the US should have a strategic reserve of Bitcoin.
I was thinking about this just the other day. There are eventually going to be something like 21 million Bitcoins when it's all said and done. And if you have a million Bitcoin, you have 5% of it. That's a huge, they're not making any more. They're not creating any more. It seems like a remarkably good trade, so to speak, to not only be in that ecosystem, but to have an asset that they can mine more gold. Someday they may be able to find it on meteors or wherever it might be, but they're not making any more Bitcoin, as the structure of how that exists. It sounds like it would be a great idea.
Yeah, I think that's probably why the White House also wants this to be a bipartisan effort. So I don't think any bill that's introduced is going to be something that only Republicans support. I think it's important that any digital asset strategic reserve be something that Congress really believes in, and therefore will survive more than just one administration.
Do you see it happening in this administration, perhaps even in 2025?
Well, the timelines are hard to tell. So, but do I think it makes a lot of sense for the U.S. to do? Yes, I think it does make a lot of sense.
As far as you're aware, are any other countries have a digital reserve or are seriously planning one?
Well, none of the major G7s have done something like this. El Salvador comes to mind, and it's been a success story for them because El Salvador actually has one of the lowest funding costs for any country. I do think there is a strategic value in the U.S. owning a commodity that actually could rise in value because it does change the way markets eventually see the U.S. deficit. Because if Bitcoin is something that is rising and the U.S. owns 1 million of Bitcoin and they're going to hold it for 20 years, that in some ways could actually offset a lot of the deficit.
Well, if they bought Bitcoin when you guys start being bullish in Bitcoin, we might not have a deficit. I don't know even what our debt problem might not be quite so much of a debt problem.
Yeah.
It's a fascinating idea, and I think people are starting to take it a little more seriously. I wanted to shift gears to geographically and look at general European stocks, the Euro Stocks 50. They trailed the U.S. sort of badly on a one last year, but year to date they've had really significant outperformance. Where I guess we're seeing this growth scare, and suddenly Europe seems to be sort of popular, although the currency itself hasn't rallied very much. What are your thoughts on that? And could actually the fact that Europe might have to grow, sort of invest and defend itself, be a medium-term plus for the Euro economy?
I probably would just start to say that in general, when an index, a global index or a regional index like the DAX or China has strength in the first few months of the year, that's a good sign. So I think investors do have to view that as a credible rise. And if Europe is outperforming year to date, I would, barring any geopolitical shift, it probably does signal that Europe could outperform the U.S. this year. Is it making sense that that's happening? I mean, in some ways, I'd say yes, because Europe is more of an industrial and financial economy. So the banks and industrials are larger weights in those indices, a lot less healthcare and a lot less technology. If the global economy is bottoming, so not considering tariffs, but just looking at what's happening with the ISM and the global PMIs, it makes sense that Europe should outperform. The dollar, if it's weakening, probably is favorable for non-U.S. equities. And as far as tariffs go, in some ways, I'd almost say that what's happening in Europe and also in Asia might just signal that the market doesn't believe tariffs are permanent changes in the sort of global financial architecture, but at the moment are negotiating tactics. And that, of course, the market could ever rethink of that.
If Europe actually had to go and spend 3.5% of their GDP as sort of on average on defense, is that ultimately going to be positive for Europe in terms of their industry that struggling a little bit, that then now they actually have to go and build things? Could that be a medium-term positive?
Well, yeah, I mean, 3.5% additional outlays for defense is very bullish for, of course, defense contractors and industrials. And it may also force Europe to really think about how they finance all of that. So typically Europe runs a balanced budget. So unless they're going to cut spending elsewhere, this could end up being stimulative.
Do you see any possibility that Europe decides we can't even, maybe perhaps even the Germans can get rid of the debt brake once they have a new government in place will that shift any possibility it shifts their thinking that we may have to run deficits for some time?
Well, I mean, there's just a lot of complex questions to ask Europe at the moment because it's not just defense, it's immigration and political turns. And so I would say someone, as hard as it is to predict what Congress would do in the U.S., it's much harder to predict what Europe will do.
That's fair. It's fair. A lot. 27 governments. Right?
Yeah.
Shifting a bit to Asia, we had this huge boost in the Chinese market in late September when they said they would stimulate and cut rates, and then that sort of has narrowed into like a range trade. How do you see Asia and China specifically, their performance so far, giving you any clues of what 2025 might look for Asia and China?
Well, it's it's not lost on anybody that Asia has really been an underperformer for the last 5 years and 10 years. But valuations have gotten so low that we should be more vigilant to the idea that a bull market starts when there's more bad news and stocks don't go down anymore. And maybe that's what we're seeing the first hints of this year, is that there's been a lot of skepticism about what China could do, and even whether or not some of the things that structurally have affected their economy are even fixable, and whether or not businesses can produce earnings in a way that can impress markets enough to get their multiples to rise. But because that skepticism exists, I'd say Chinese stocks have outperformed expectations. So I think people should just be aware that China might be finally a case where all the bad news is baked in.
Do you think that it's time for Americans who've done really well with the Mag 7 and an S&P 500 over the past, since 2022, since the end of 2022, is it time to start allocating a significant amount of capital to indices in Asia, in Europe, if there's concern about the goal of lowering interest rates here? Is there more value elsewhere? Should people allocate a little bit more outside of the country?
I think what most people have to be aware of is that U.S. investors principally stick with U.S. So I think if Mag 7 starts to consolidate, and our bet this year was that Mag 7 wouldn't lead. That's why financials and industrials are our number 1 and 2 picks this year. It's really painting a picture of a broadening market. And in the past, that would mean U.S. investors just allocate more to mid-cap and small-cap, or to other sectors, including things like staples and healthcare, which have underperformed. But there is, of course, investors who do trade outside the U.S. It's more of an institutional universe that does that. It's not really that common for U.S. investors to own Europe or Asia. They do through ETFs, but that's really not as pronounced an allocation for them.
So perhaps folks, a lot of allocation in the S&P 500 or which is Mag 7 has an over sort of weight driving it. Mid cap and small caps might be a better an alternative destination for.
Yes, that's right. But I think for those who do global allocations, I think the case for owning Mag 7 still exists, but to be overweight Mag 7 probably diminishes this year. So I do think that there is going to be money flowing to Europe and Asia, but it won't necessarily be the U.S. individual investor.
Right. While we're on the topic of Mag 7, I suppose 2024 might have been the year of AI. It sort of seemed to jump into certainly every retail investor's consciousness. Do you see that as, was 2024 the top in AI, or just now a precursor, a break, and then we'll see a sort of much bigger impact in terms of not only the impact on the economy, but sort of, the impact on investing.
Yeah, I think it's too early for people to call the top in AI, because AI's capabilities we haven't even set an upper limit to what AI's upper limit is. Like, is it super intelligent? Is it quantum super intelligent? So I don't think, and if we look at penetration rate of AI in everyday life, it's still very low. We're in the earliest stages. So to me, I don't think that we are pricing in everything that comes from AI, but does that mean AI stocks have to lead in 2025? I think that there is a lot of architectural changes happening in this economy because of the new administration, and that's why I think Mag 7 and AI aren't necessarily the leading stocks this year.
I will shift gears a little bit. I remember you're a keen student of demographics in our last conversation. One thing that struck me recently was they were looking at marriage rates by decade. And in recent decades, I think the people who were born in the 70s were still getting married reasonably early, and a large number of them were getting married. But in the subsequent decades, the 80s and the 90s, they've dropped dramatically. And the research has also shown that if you're not married, if you're simply, or certainly if you're single, but if you're simply cohabitating, that the wealth accumulation in those family units is much, much lower than they were when people are married. So if you think about it demographically, what impact do you see? Is there a gradual, I wouldn't say maybe impoverishment or less wealth in households as time passes? And we're talking about decades here, but do you see that? And if so, do you think it's investable in some way?
I think it's too early. I'd say people, there's a lot of research done out there, and I think a lot of it is mental guesses. For instance, I'd actually point to opposite research that shows that Gen Z, which is this youngest generation, actually is adhering most closely to traditional family values. Like, adoption of formalized religion is rising. It's higher than it was in Gen X and millennials. And so it would argue exactly the opposite, that most likely we have a generation coming up that's going to get married and have kids even earlier. So we might have already reached peak late, people with late births, that could be reversing. So I don't know. But what I would point out is we know that the wealthier cohorts, which is really the baby boomers and now the older Gen X, have accumulated more wealth than they'll consume in their lifetime. So that wealth will be inherited by the next generation. So the U.S. has household net worth of $150 trillion. Global U.S. GDP's under $30 trillion. If you have 5 times the net worth relative to GDP, you could essentially end the economy, and you would still have an economy because there's just so much accumulated wealth.
And things keep sort of going for a while, even if you stop producing in a way, you have a fair amount of cushion, so to speak.
5% interest rate, that's $7 trillion a year of income. That's just without even having to wake up except drink your coffee. So,
and $5 trillion that has to go either in, either in the stock market or in the in your S&P ETF or at least in some sort of interest-bearing.
Yeah, I think the U.S. economy is still very well positioned, is really what I'm just saying. That it's hard to say there's really a pronounced negative shift in the demographics.
That's great. Well, Tom, thank you so much for spending time with us today. It's a really interesting times when decades happen in weeks. Thank you so much.
Yep, thank you.